Hi everyone, it's Paul Tilley. Welcome back. In this last video for the first chapter, what I wanted to do was to incorporate all the things we've talked about so far into a review of the actual mechanics of recording transactions. We've looked at, in the first video, the idea of the fact that accounting uses certain methodologies that are standardized so that we can create a clean picture of how any business looks. So effectively, the same measurement tools are used to measure business A, B, and C, so we can look at A, B, and C and say, how are they performing relative to one another? In the second video, we looked at the various statements that are used in order to present that information. So we've talked about balance sheets, income statements, and the various other statements that are used to look at changes in equity or cash or these sorts of things. So as we look at that accounting cycle we talked about, we need to think about how do we record events from the start of the year to the end of the year, or the start of the period to the end of the period, okay? So that's what we call transaction analysis. And in this particular video, we're looking at some simple examples of transactions and analyzing how they're recorded so that we can look at what impact it has on the balance sheet from the beginning to the end, how the income is recorded in the income statement, and the various changes in the financial position and cash position. So let's take a look at the basic accounting equation to start with. The basic accounting equation effectively mirrors the way the balance sheet is set up. Assets are equivalent to or equal to the liabilities, what's owed to outsiders, combined with equity, which is what's owed to insiders. So what you own is on the left and what you owe is on the right. What we owe is broken into components, what's outsiders and what's insiders. So assets equal liabilities plus equity, and they will always be in balance. So the assets describes what the organization has invested in, the tools that the organization uses to do what it does is recorded in assets. The liabilities describes what non-owners have put into the business. They're financing the business. They're loaning the business money in terms of short-term loans, in terms of long-term loans, these sorts of things, and all that is recorded against the assets. Equity describes what the owners put in. So between what the owners have put in and what outsiders put in, two of those things together add up what the business owes. Remember, the business is a separate entity, so it owes it to its owners and to outsiders. Liabilities and owners' equity are combined together to tally up what the business owes. What the business owes will always match the assets, what it owns, what it has in order to do the job that it does. So the accounting equation describes a relationship between a company's assets, liabilities, and equity. As transactions occur, we see changes in assets, liabilities, and owner's equity. And what we're really doing is recording these changes as we go along. This recording is called transaction analysis, and what we do is we need to determine which account is affected whenever a given event occurs, and if the account is increasing or decreasing. So let's look at some examples of a scenario of transaction analysis for this company. So in the first instance, let's look at Hailey Walker, the fact that she invested $10,000 cash into the business. So Hailey took it out of her pocket, gave it to the business. Now we think about it, remember the business is a separate entity, so the business basically owes her $10,000, okay? So the business has $10,000 in its bank account, and the business owes her $10,000. The bank account is considered an asset. It is a plus, so it gets added to assets. So $10,000 gets added to assets. In terms of the other side, liabilities and owner's equity, the owner is owed $10,000, so it gets added to owner's equity. Now notice that assets, $10,000, Liabilities and owner's equity, $10,000. They both match. Let's look at a second transaction. In this transaction, they went out and they purchased $2,500 worth of supplies for cash. Okay? So what comes into the business? What is coming in? Well, there's $2,500 worth of supplies. It's an asset. So under the assets, we would see assets go up by $2,500 because $2,500 worth of supplies went in. But also, we took $2,500 cash, which is also an asset, and we took it away from the business. So the asset cash went down by $2,500. So the asset of supplies went up by $2,500. The asset of cash went down by $2,500. Notice that assets still equal liabilities plus owner's equity. Let's look at a third transaction. In this particular case, we purchased $1,100 worth of supplies on credit. So again, similar to the last situation, we had $1,100 worth of supplies coming into the business. So that asset went up by $1,100. So we had an increase. Look at the supplies over there in the corner. They're assets for the business. It's $1,100 worth. It's recorded as an asset of $1,100. The thing is, though, we owe money for that. We have not paid any cash. There's no change in cash because we haven't actually laid out any cash. In fact, we've written an IOU to the supplier of $2,500. That is a liability to the business, right? That's money that the business owes. So we record liabilities going up by $2,500. So assets went up by $2,500. Liabilities went up by $2,500. The asset equal liability plus owner's equity equation is still in balance, as it must always be. In the next scenario, purchased $6,000 worth of equipment on credit. Again, very similar. A promissory note was signed. Okay, so we've got equipment coming into the business. It's worth $6,000. That's an asset that's going to be used in the business. Assets go up by $6,000 because that equipment is an asset. So that category of assets went up by $6,000. There was a note, which is an IOU, promised to the supplier. So that's a liability. It also goes up by $6,000. So again, assets equal liabilities plus owner's equity is still in balance. Assets went up by $6,000 and the liabilities went up by $6,000. So let's look at another scenario. In this one, services rendered for $2,200. So the business went and did some work and it received $2,200 cash. When the money comes into the business, we see cash goes up, our bank account goes up by $2,200. And also, the fact that revenue has come into the business means that the business is worth more. In other words, the equity in the business goes up by $2,200. Again, we look at it and we say assets went up by $2,200. Equity on the other side went up by $2,200. Assets still equal liability plus owner's equity. Number 5, we look at payments of $1,000 for rent in cash. So what we did is we paid our rent bill for $1,000. So we effectively took $1,000 out of our bank account. So that asset cash went down by $1,000. That's on that asset side. The money that is drawn out of the business to go to pay something, be it rent or money that's flushed out, effectively reduces the owner's equity by that amount. So owner's equity goes down by $1,000. So the asset went down by $1,000, owner's equity went down by $1,000. We're still in balance because assets equal liabilities plus owner's equity. Both sides dropped by $1,000. We're still in balance. Let's look at another transaction. So payments of $700 salary expense in cash. Very similar situation. Cash is reduced by $700 as money flows out of the business, and the equity is reduced by $700 on the owner's equity side to reflect that the money is drawn out, or that money is less, the business has less money, so it would be considered as a reduction in owner's equity. How about a service contract for April? We signed the service contract. There's no real issue here in terms of a recording. So there's no accounts affected. So we do not do a journal entry or an entry for that. Number 8, services and teaching revenues of $1,900 rendered for credit. So effectively, we've had revenue for $1,900 come into the business, of which $300 is for teaching and $1,600 for food services. There was no money changing hands here. However, there was a promise to pay by whoever bought the service from. So that would be considered as an accounts receivable. We call that an accounts receivable. It is an asset. It's money that's going to come in at some time. We just record it when the revenue occurs, okay? So the fact the money hasn't flowed really doesn't matter. The fact is that the revenue has occurred, and we record it as such as an accounts receivable for a total of $1,900. The fact that the money is promised to come into the business means that the other side of the equation, the owner's equity, will effectively go up by $1,900. Okay, so we've got a promise to pay coming to us for $1,900. That goes, assets go up by $1,900, and owner's equity on the other side of the equation goes up by the equivalent amount. Now let's assume in this number 9 that the receipt of the cash comes in. So what we've got is someone actually paid the bill. So we got $1,900 coming in. So $1,900 comes in. Our cash, or asset cash, goes up. Okay, we've got more cash coming into the business. Cash goes up. But that amount of accounts receivable that we had in the previous one, because it was recorded as it's money coming in eventually, we need to take that down by the equivalent amount. In other words, the money's coming in now, so the accounts receivable goes down by $1,900. So cash went up. The asset cash went up by $1,900. The asset accounts receivable goes down by $1,900. Assets equal liabilities plus owner's equity is still in balance. Particular number 10, payment of $900 accounts payable. In other words, we're paying a bill. So this one, our cash is going to go down by $900 to reflect the fact that we're paying the bill. And in this particular case, there was an accounts payable on the liability side. In other words, we recognize that we had to pay $900. Now that we paid it, that comes up by $1,900. In other words, our accounts payable is less by $900 because we actually got the money. Number 11, we withdraw $600 cash by the owner. Well, effectively, we know cash goes down. So the asset cash drops, and the owner took the money out, so owner's equity drops by that amount. So owner's equity goes down by $600, cash goes down by $600, assets equal liability plus owner's equity is still in balance. Now that we've recorded all the transactions for March, we'll have a tally of what the assets, liabilities, and owner's equity was at the end of the period, after all of those changes. And this information is really used to prepare the financial statements. So you can see that the financial statements in summary now will reflect what the business looks like after we've done the month. So our revenues, for example, we had $3,800 in food service. We've had $300 in teaching revenue for a total of $4,100. We've had some operating expenses. We know we had to pay the rent and our salaries, so $1,700. So our profit was $2,400 during the period. On our statement of changes in equity, which will be prepared next, what we're trying to do is to figure out what happened to our equity position. So if we look at our statement of changes in equity in the green there, she invested $10,000 to begin with. She had $2,400 profit. That brings up the total equity to $12,400. She withdrew $600. So at the end, she had $11,800 in owner's equity. From there, we can go on to prepare our balance sheet. So our balance sheet would give us a tally what the situation in our business and assets, liabilities, and owner's equity looks at the end of the period. So we know we got $8,400 in cash, we got $3,600 in supplies, $6,000 in equipment at the end, for a total of $18,000 in assets. The liabilities, there was $2,000 left in accounts payable, notes payable was $6,000 for a total liability of $6,200. From the statement of changes in equity, we can see that her equity is $11,800. We add up the total liabilities and total equity. We know that the total liabilities and equity is $18,000. And that is how the system works. It records the transactions, and at the end of the period, then we can create our financial statements.